Considering the volatility of cryptocurrencies, it is definitely not a good choice for a sound retirement plan. A retirement plan has to be reliable because in old age, it's not feasible to take risks and be subjected to violent price swings of your invested assets. The modern portfolio theory is mainly used to determine asset allocation in a portfolio, and generally, there are 5 to 10 portfolio choices available to an investor. Harry Markowitz, an American economist, presented an essay on modern portfolio theory in 1952. He received Nobel Prize in economics for it, and the findings of this essay substantially changed the perception regarding asset management and risk. This theory is still considered a cutting-edge solution for effective portfolio management. The two main features of this theory are: for any investor, the goal is to maximize the return for a given level of risk, and two, the risk can be reduced by making a diversified portfolio unrelated assets. The reason for including explanation of this theory is to dispel the myth of investing in cryptocurrency in the hopes of creating reliable retirement savings. The other name for using this approach of modern portfolio theory is passive investment. Without complicating the concept of portfolio theory, understand that the objective of this approach is to build the right risk to return portfolio for a broad range of assets that have substantial value. This approach is less exciting but also less frustrating, as the emphasis remains on reliability, where your investment stays relatively secure regardless of the day-to-day changes in the market. And considering the price change graphs of cryptocurrencies that resemble a roller coaster ride, investing in digital currency is anything but reliable for retirement savings. Let's briefly define risk and return. Return is the appreciation and price of an asset, just like the increase in a stock price. The return also includes any capital inflows such as dividends. Standard deviation is a means to measure the risk because an investor ideally seeks to have steady and gradual increase in the price. Extreme jumps in price can be dangerous because they normally indicate volatility. And as we have seen in the case of financial bubbles, big swings can also end up in losses and extreme losses. Another way to look at standard deviation is the range in which the price of an asset varies on average. For instance, if the price of an asset shows 10% deviation from the mean with average expected return of 8%, the investor can observe the returns between -2% and 18%. To give you a practical example of Markowitz portfolio theory, let's assume that there are two portfolios of assets with an average return of 10%. Portfolio A has risk or a standard deviation of 8%, and portfolio B has a risk or standard deviation of 12%. Both portfolios have the same expected return, and any investor will choose to invest in A since it has same expected return as of portfolio B, but with lesser risk. Now, this is the reason you need to understand risk as an analyst, because there is no expected reward without risk. Investors get compensation for bearing the risk, and theoretically speaking, the higher the risk, the higher the return. In our example, it might be very tempting to presume that portfolio B is more attractive than portfolio A, since it has a higher risk at 12% and a potential return of 22%. But there's also the possibility that it will return -2%. Provided that all things remain equal, it's still preferable to hold the portfolio with the expected range of returns between +2% and +18%, because it will more likely get you closer to your financial goals. Risk, as we have seen above, is a welcomed factor when investing because it allows us to reap rewards for taking on the possibility of adverse outcomes. Modern portfolio theory, however, shows that a mixture of diverse assets will significantly reduce the overall risk of a portfolio. Risk, in other words, has to be seen as a cumulative factor for the portfolio as a whole and not as a simple addition of single risks. Assets that are unrelated will also have unrelated related risk. Now, this concept is defined as correlation. If two assets that are very similar have similar characteristics, it means that their prices will move in a very similar pattern. For instance, two ETFs or two exchange traded funds from the same economic sector and same industry are likely to be affected by the same macroeconomic factors. In other words, their prices will move in the same direction for any given event or factor. On the contrary, two ETFs or two exchange traded funds from different sectors and industries are highly unlikely to be affected by the same factors. This lack of correlation is what helps a diversified portfolio of assets have a low risk, which is measured by the standard deviation, than the simple sum of risks of each asset. Without going into the detail, a bit of math might help explain why. Correlation is measured on a scale of -1 to +1. +1 indicates a total positive correlation, which means that prices will move in the same direction par for par, while -1 indicates the prices of these stocks or two assets will move in opposite directions. If correlation between all ETF pairs is 1, then it would seem reasonable that the total risk of the portfolio is equal to the sum of the weighted standard deviation of each individual ETF. Whereas a portfolio where the correlation of asset pairs is lower than 1 must lead to a total risk that is lower than the simple sum of the weighted standard deviations. The magic of building different pairs is that by different combinations, it's possible to achieve basically every risk to return combination, even different from the risk to return level of single components. The efficient frontier is like the backbone of modern portfolio theory. It was also introduced by Markowitz, and it's very easy to understand. The name might sound a little daunting, but it's very simple. It's the graphical representation of all possible outcomes of risky assets for an optimal level of return at any level of risk. The risk, of course, is measured by the standard deviation. Now, this chart here shows a hyperbola showing all outcomes for various portfolio combinations of risky assets. The standard deviation is plotted on the horizontal axis or x-axis and the return on the vertical axis, the y-axis. The straight line, also known as the capital allocation line, represents the portfolio of all risky assets and risk-free assets, which is normally AAA rated government bonds. The tangency portfolio is the point where the portfolio of only risky assets meets the combination of risky and risk-free assets. This portfolio maximizes the return for any given level of risk. The portfolio along the lower part of the hyperbola will always have the lower return and a higher risk, whereas the portfolios to the right will have higher returns but higher risk.